Okay, so we'll get started. Hope you guys enjoyed our bantering as we try to entertain you for 5 minutes. My name is Alex Wilson, team lead and broker owner of Remax Wealth Builders Real Estate. Below me, we have Kyle, co-founder of Wealth Builders Real Estate and also an investment expert. He's going to help moderate today. And then our man of the hour, Amit Puri, a award-winning mortgage professional-wise. Did the most volume in Ontario in 2018 and 2019 for mortgages wise, and he specializes in investments, and particularly condos. So we are one of the top brokers for pre-construction condos in Toronto, and he works with all of my peers as well. We all know him well, so he knows what he's doing in this space wise. And that's why we have him talking with you all today, because he knows how to get these transactions done. And you'll get a feeling for that as we talk and discuss about getting the right professionals on your team to move forward. And not only is he a mortgage professional, he is also a chartered accountant as well as an investor himself. So these are the qualities you want in someone when they're helping you structure your portfolio wise. And my favorite line that Amit has given me over this month that we've been doing this webinar is, Amit, can I get a mortgage? What's the answer to that?
Absolutely. Just depends which bank and what rate.
Exactly. Yeah. So I was actually talking to my wife about this last night, and we were talking about an instance, which Amit, I'll give you a call later on this. And it's actually an older individual that is retired but owns an income property, and my wife is like, will she even be able to get a mortgage? And I said, well, my good friend Emmett, he says everyone can get a mortgage. It just depends how much they're going to charge her. So when you're dealing with someone that knows how to get mortgages, that's who you want on your side. And I can say there's nothing more stressful than mortgage stress. I've done many mortgages. I've done every type of mortgage. So not only have I done the A-type lending, I've done the B-type lending, and I've done the private lending. Personally, I've borrowed all those money in different circumstances. So I know mortgages can always be got. But what we're going to talk about today is how to build your portfolio using the equity in your current investment properties to have multiple properties that are going up in value at once. So basically how we're going to go over this is I'm going to allow Amit and Kyle to give a brief intro on themselves. Then we'll go into my presentation wise, where I show you step by step how I grew an initial deposit of $39,300 into my $14 million real estate portfolio today. You're going to see how easily it can be done. I shouldn't say easily, but anyone can do it wise. It just takes time and patience, and not even hard work. There's not even hard work involved. It's just understanding what needs to be done. And we walk you step by step. I show you my whole portfolio wise, and then we'll open up to questions and help inform you, because this is all about education. We want to empower everyone here so that they can build their own financial freedom and generational wealth. And there's many ways to do that. We just believe in the real estate method, and that's what we're teaching people today. So first off, Kyle, why don't you give a little bio on yourself?
Yeah, thanks, Alex. So I started purchasing investment properties back in 2012. Alex and I actually invested in our first properties in the same development, and that really got me excited and involved in real estate investing. At that time, I was actually working in the gambling industry. I had worked for an online poker company and then had moved to actually run Canada's largest lotteries. You may have heard them, Lotto 649 and Lotto Max. I was actually performing the draws and responsible to conduct those draws. And I realized that I wasn't happy in the gambling industry. And I had seen the real estate investments that I was doing, working and growing, and, seeing Alex and his success, and decided to join Alex as co-founder of Remax Wealth Builders to help others build their own real estate portfolios and really invest. I don't want people to gamble on their retirement. I want them to invest and grow a real estate portfolio and investment portfolio for their retirement instead.
And Kyle's background is in business and computer. It was computer science, or was it computer
Yep.
electronics? Computer science. And so he has a very strong business background
Mhm.
and extremely conservative. Extremely conservative. So when he says it's not about gambling wise, and even I'm conservative with my investment wise. I have limited exposure in the stock market wise. I may take larger risks. I'll put it perceived risks in the real estate world, but they're all very calculated risks on my end, which I feel comfortable with because I've been doing it for 11 plus years. But Kyle definitely analyzes things up and down wise. So it's a very conservative approach that he takes. And the great thing about real estate is that we are talking about leverage, and people are adverse to the word. Actually, people aren't averse to the word leverage. People are averse to the word debt. And I specifically say leverage in this case because leverage is when we use other people's money, the bank's money, and then put it in an investment making asset that is going to make us more money wise. And the key to this is the tenant landlord relationship. The tenant is the one that's offsetting the cost of the additional leverage wise, the interest on the money borrowed. That is the key item that I consider makes real estate investing incredibly safe and conservative wise because I have an income stream, uh, almost a guaranteed income stream up against the additional costs that I'm taking on with the property wise, which you'll see the benefit of that as we go through the presentation wise. So I just wanted to add that Kyle is a very conservative individual. So, and you'll see that as we go over our numbers wise, how this benefits everyone on this call.
And it fits my personality more as well. You know, the long and boring investment horizon is great because you don't have the constant downs like you do in the stock market with real estate. So I like the long-term horizon approach, you know, not checking your portfolio every day, just that tenant slowly paying off those mortgage balances year after year.
Yeah, definitely. And I'm in some chats where people do trade in the stock market, and it's like you got to be. It's like you're playing fantasy sports. You got to be on top of that every day. And if you're missing something, you can get in trouble. Why? So, but I'm not going to go down that rabbit hole. And then Anna, why don't you give a quick bio on yourself?
Absolutely. As always, thank you so much. It's an honor being here and a part of the team. Quick background on myself. Born and raised in London, Ontario, went to York University where I did a business degree at Schulich School of Business. I became a CA, worked downtown for KPMG and Deloitte. Got tired of counting other people's money, so I decided to get into the mortgage space. That was about 12 years ago when I think Alex, you and I met. In a nutshell, I'm the same. Going with what you guys said, I don't have much money in the stock market. I don't believe in it. I think it's just professional gambling. It's no different than putting money on red or black at the casino. I mean, which way a stock is going to go is, if you look at the horizon of the stock market, it generally people don't outperform the index. So, from a mortgage perspective, I'm an investor. The numbers make sense. I'm conservative simultaneously, like we had said before. I think the biggest challenge that investors have is they start to max out at certain lenders. I started my career at TD, and I always say that when I worked at TD, I would have 10 people come to me and I could help six. But now I have 10 people come to me and I can help all 10. Because knowing the policies at every single bank is what has taken me a decade to become a professional at, whether it be Scotia, TD, National, CIBC, Desjardins, Manulife, you name it. Like the list of lenders that are available in Canada, there's about 40 different banks, and most people only know the 5 or 6 banks that have branches. There's a ton of lending opportunities. So when it comes to investing, providing people with the investor advice, the accounting advice, on top of that, the mortgage advice, that's what I'm here to do. So pleasure to be on the call, and thank you.
And you know what? I don't even think we've covered this in previous chats, but something popped in my mind because I saw it this week in a news article. We kind of stocks and everything like that. And I'm not against the stock market. I just sell real estate, and so I know real estate. But Warren Buffett made a comment. He said, "You face financial ruin through the 3 L's. It was ladies. Sorry, that's actually kind of gender. That's probably kind of sexist. So that was a 3 L's. So, but you know,
It's okay. Warren Buffett said it.
yeah. But they said ladies. I'm trying to think of one thing and make it gender not specific. But we'll just get off that one because I'm going in a whole and leverage. So, but here's where the key thing comes in, and this is where you really make money real estate wise. What he was referring to leverage wise, if you were to borrow money to buy stocks, he's like that's where you get in trouble, because again, key thing is you don't have the income side associated with the asset, so you're purely relying on appreciation. So where you make real money in real estate wise is with leverage wise, because you have the income streams to associate with the additional expense of the interest wise, but you have but you're growing your portfolio, and then you have tenants that are paying down the properties, and that's when you start getting exponential returns on your investments wise, and you play it over a longer period. So I read that this week, and I kind of stepped back. I'm like, oh no, Warren Buffett said leverage is bad, but he was referencing the fact of using leverage to go into the stock market wise. And the returns that we make in real estate wise are based on leverage, but we have the income side matched to it. So I just wanted to make that comment if it sticks with anyone.
Absolutely. Actually, just to piggyback on that, and just a housekeeping comment. Anyone that has questions, there's a Q&A tab at the bottom that they can start populating questions in. I know I saw a question come from Charles in the chat, but on the Q&A would be better. But anyway, going back to Warren Buffett, there's actually a famous video of him on MSNBC Money in the 2008-2009 crash, where he clearly says that sign me up for buying 500 houses where someone's paying the bills and the money is at dirt cheap rates. The problem is scalability. And he talks about the fact that if you could find a way to manage it, that's the key to long-term safe investing. So I know it's on YouTube. I've seen it 100 times and I send it to people, but I'll send that out to you after. But he strongly believes that, stocks are great, but the problem is, and when you get into your presentation, it's capital. It's how much money is working as opposed to just the investment.
Do you know where Warren Buffett started his investments wise? It was actually in insurance, and he loves insurance because again, you're matching an income stream. You have guaranteed income streams with the asset. So everything's all about guaranteed income streams. You can go buy Tesla stock, and you've seen a crazy run on Tesla stock wise.
It's up 300% just in the last couple months.
Oh yeah, it's 500% over the last 365 days. That is crazy, but you have no income stream attached to it. Zero. So it also is highly volatile, so you could lose your shirt on it as well. And that's one stock of many others that have failed wise. So this is all long and boring wise. I'm really going down rabbit holes today. So I'm going to get myself back on track, and I'm going to start my presentation and talking about what I know. Okay, if you own investment properties, even if you own one, it's important that you maximize your portfolio. Equity in your property is dead money. So I'm going to go step by step to show you why it's dead money. But equity in your property is dead money. It's great if you bought a condo for $300,000 and it's worth $600,000 today, but that $300,000 worth of growth, that is not being reinvested. So your actual rate of return based on the rent that you're getting on the property is quite poor. But let's say you could take that 300 or a portion of that 300 and reinvest it somewhere else. That's where things can get really attractive and where you can see growth wise. So you want to take the money out of the property, use your equity, other people's money to expand your portfolio. And that's where leverage comes into play. And you always want to make sure you are paying the right and lowest interest rate. So since Amit and I've been doing this, I'll forward him, people will reach out to me and then I'll forward him individuals wise. And they're like, oh, I have this property, there's a lot of equity on it. I have this mortgage, I don't know what to do. There are times when, let's say, for example, last year you locked into a mortgage, a 5-year fixed mortgage wise. Well, it may make more sense for you to do a home equity line of credit on that property to start tapping into the equity versus doing a refinance at that time because the breakage fee might be too high. Or it might make sense even to break it 1 year in. That's where Emmett would talk to you and see what makes sense from a financial standpoint wise. So you always want to make sure you're paying the right and lowest interest rate in respect to your circumstance. There is one golden rule though that I'll say: if you're using your principal residence to invest, at that time that you do not want to refinance, you want to use a home equity line of credit off your principal residence that you live in to invest. That is definitely a golden rule wise. That's you're not going to refinance your principal residence to invest. You want to use a home equity line of credit if you're using that. So the cash flow management, the Goldilocks method is what I like to call it, how I build my efficient portfolio. So too much positive cash flow just gets taxed away. If I would have leveraged, I could have increased the equity of my property to purchase more investment units. So I'll just give an easy example. Let's say I have a condo, it's rented out, and I'm generating a great monthly income of $400 per month. Well, $400 per month, and I'm at a higher tax bracket wise, so that means 54% of that is going to go into the government's pocket wise. So over half of that is gone because of tax wise. So really my net amount of income available is less than $200 per month. That doesn't make a substantial difference in my life wise. But if I would have refinanced a property, reduced that cash flow because I've increased my interest expense, at that point now I can have multiple investment properties. So now I've actually made a difference in my life. Not because I have more cash flow on a monthly basis, but I have multiple assets that are increasing in value. And over a long period of time, that makes a big, big difference, which you're going to see. But you also don't want to go into too much negative cash flow and expose yourself to extra risk. If you're not able to maintain our monthly obligations, we put ourselves in a situation where we have to sell. Now, you only lose money in real estate when you sell. So don't sell. So what I mean by that, never put yourself in a situation where you have to sell. You can ride out any bumps in the road as long as you're running your portfolio efficiently and not exposing yourself to extra risk wise. So neutral cash flow, which I call the Goldilocks method, that minimizes our taxable rental income. So we've reduced our cash flow. We haven't gone to negative. We've reduced our cash flow, and we efficiently use the equity in our properties to maximize the number of investment properties we own, and they're appreciating in value and having the equity pay down as well. That really should say principal pay down. But when you have a tenant in there, that's your monthly mortgage payment is made up of two things. One, it's made up of the interest payment, and two, it's made up of the principal payback, so paying back the loan. And if you have a 30-year amortization on the property wise, in 30 years, that loan will be paid off. And again, you're going to see the value, the power of that later on. So I want to show you an example of how I built my portfolio and how leveraging has benefited me. So my first investment condo, same building that Kyle bought in, original purchase price of that condo was $262,400. The current market value in 2018, so I did this example in 2018, the current market value of my condo is actually $600,000, but when I did this in 2018, it was $500,000. And why I haven't even updated this slide is I get to actually show that my growth model has followed the trajectory that I've mapped out for it. But in 2018, the current market value of the condo was $500,000. The current mortgage on the property was $202,841. The market rent on the property was $2,100 per month. So because my mortgage was only $202,000, but the current market value was $500,000, I was able to go to the bank and get an 80% loan to value mortgage on the property. So that means, 500 times 80 equals 400,000. So I had 400,000 of refinancing available. So what does that mean? I pay off the current mortgage of 202,000. So that's gone. I have a new mortgage of 400,000, but that 400,000 is being covered by the monthly rent I'm getting on the property. So with the monthly rent on the property, there's no extra money coming out of my pocket wise. And what I've unlocked is $197,000 of investable equity money. So I literally get a check from the bank for $197,000. Now, I don't go buy a car. I don't go on vacation. I go reinvest that back into more real estate. So this is how I turned one condo into 3 condos. I used that $197,000 to buy 2 more pre-construction condos wise. I bought one at 75 the Esplanade for $380,900 and one at Canary Block for $578,900. The deposits on those were $57,000 and $115,000, made up $172,000. Now the key thing is, I bought these pre-constructions, then they went up in value. So they went up $320,000. So by just leveraging right off the bat, I made $320,000 by buying 2 pre-construction condos. Not a bad return, but there's more. This is the value of time with real estate wise. So now instead of 1 property going up in value, I have 3 properties going up in value. So what happens over 5 years? So assume a conservative 5% annual compounded growth, where the average appreciation of a downtown Toronto condo has been 9.4% over the last 5 years. So conservative numbers, very important. So in 2023, because remember I did this in 2018, in 2023, what is my Carnaby condo going to be worth? Well, the value of that Carnaby condo, didn't sell it, just leveraged money out, $638,000 would be the value. Plus there's equity pay down of $44,000. So that every month, over 5 years, that tenant paying down my mortgage, I've made $44,000 on just the equity pay down. So by keeping that condo, $282,000 is what I make. Then, remember I bought 2 other pre-construction condos, which are going up at 5% per year. So again, the 75 the Esplanade, that goes up in value. So now on top of the initial gain, I make another gain of $133,000 over the next 5 years. That continues to go up in value. And my Canary Block condo, that continues to go up in value. Now there's no equity pay down on these because these are pre-construction. The Canary Block condo goes up in value. That goes up another goes up to $957,000. So I make another $207,000. So the total gain from 2018 to 2023 by owning 3 condos is $622,000 just on appreciation at 5% compounded annual growth, a very conservative number. So I leveraged the equity out of 1 condo, $197,000, turned that leveraged equity into 2 condos with the current appreciation of those with $320,000. And then at the end of 5 years, those 3 condos went up $622,000. So by the total gain from leveraging my 1 condo, so not selling it or anything like that. So I leveraged the 1 condo, I get 2 more condos, $943,000 is what I get by leveraging the 1 condo and purchasing 2 more condos. That's the value of time. Now, if I didn't leverage, well, I still have the 1 condo. I didn't sell it. So it's 5% annual compounded growth wise. It's 622,846. Current market value is 500. Equity pay down. My equity pay down is not as great as my first one because I've been taking more cash flow in as opposed to paying down the equity wise. So I do get the extra cash flow, so another $40,000. Total gain without leverage, $185,364. So my leveraged versus unleveraged condo, the difference is 409%. That is my value wise of leveraging versus not leveraging the condo. Which condo would you prefer? Not condo. Which portfolio would you prefer? And then what I've done is I've done this exponentially wise. I've done it many, many times, and I bought many, 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 many properties. So here is my current market, the today current market value on these properties wise, my 2020 value. And what I looked at is what are the value of these properties in 10, 20, and 30 years? And why 30 years is such a relevant number and just easy math for everyone here. Just assume neutral cash flow and everything. I'm not making excess cash flow. Just my mortgages cover my costs, and that in 30 years, all my mortgages will be paid off, because that's the amortization period on an investment condo is 30 years with 20% down. So in 30 years, my entire portfolio will be worth $33 million. And this is at a compounded annual growth rate of only 3%. So not even 5% anymore. I went ultra conservative, only 3% growth per year over 30 years. Now, I'm very aware about inflation wise. So someone may say, well, what about inflation, Alex? You know, is that what is that $33 million in today's purchasing power? So what does that mean if I had that $33 million today? So in 30 years, this would be the equivalent of $19 million today. And what I did is I just went back 30 years to 1990 and then calculated what $33 million would be the equivalent of in 1990. So that's $19 million worth of purchasing power that I'll have, today's purchasing power that I'll have in 30 years. And I've done nothing. I shouldn't say I've done nothing. I had to find these properties, I had to buy these properties. I had to get the mortgages on the properties. There's work involved in all of that. But once you have these properties in place, you have the tenants in them that are going to be paying off the mortgages wise. And I'm going to stop share here. And this is where I bring Kyle in, because I like Kyle telling this story. Everyone may be like, oh my God, like that's not possible. That's crazy. I can't do that. I can't fathom the growth of these numbers wise. We have a great video that we did about, it was a Portuguese immigrant that came to Toronto wise. And he recently passed away. I believe it was this year. And he accumulated quite a real estate portfolio wise. And Kyle will just kind of give you the summary, and just you can watch the video. It's in the Toronto Star, everything like that. He applied this model, and this is what he did. And Kyle, take it away.
Yeah, no, exactly that. He was an immigrant that came over from Portugal without really any money to his name. He got a job working with the TTC as a bus driver. So, you know, good, decent salary. And what he did was just slowly buy up properties in Toronto. He did it in his local neighborhood. And every time a house, you know, kind of came up for sale in the nearby area, he started buying them. And after 20, 30 years, he ended up with a $15 million real estate portfolio. You know, started with nothing, and he was able to grow it. And it really just demonstrates that anyone is able to do this. And with the right partners like Amit, you know, you can finance them, you can get mortgages for it, and anyone can really do it.
Yeah, and anyone can do it. And he was just a TTC driver, bus driver, and had an income wise. And you start buying properties, and then you match up the properties with an investor. Now, the difference between what he did and what we're doing is, and condos weren't as prevalent back then. He was buying freehold properties wise, which do require much more work. Why we like condos wise is they're just concrete boxes in the sky. So you can be a busy professional and you buy these assets, and it's really limited work that's involved. There very little things because it's a concrete box, maybe it's an appliance that goes, that kind of thing. That's all you're going to be dealing with in the condo wise, because the exterior of the unit is all managed by the building. There's a building management in those. So you're really not dealing with any issues wise. And that's why there's a scalability factor to that, where we go back to Anna and we talk about the Warren Buffett wise. If you could manage these properties wise, which I have a property management company as well, but if you're focusing on condos wise, again, you're dealing with limited issues, where with a house, roof, exterior brick, water pipes bursting, landscaping, all that kind of stuff, you're dealing with that. So what we'll do is we'll open it up to questions wise. You can ask the questions in the Q&A part wise. We love answering these questions. I know Amit's already been typing away. So I'll read out the questions. Amit's already answered the questions directly to some individuals wise, but I'm going to, I'll read them out and I'll answer them. So Charles starts off with first question. What about dividends from stocks? When Alex was talking about how stocks don't have an income aspect and only appreciation aspect. Great question. I don't know what Amit wrote because I haven't opened it yet. Yeah, you have dividend stocks wise, but you can't leverage. Well, you can leverage, but it's very risky leveraging a property and then investing in the stock market wise. Yes, you can have a dividend associated with that with the property, but it can't leverage the stock, right? So where you look at my whole portfolio, I buy one property, it starts going up in value. Then I can leverage that property and buy another property and leverage that property and buy another property and continue the leverage train, all while associating a rental income with that. Yes, I could buy a dividend-based stock with my leverage income. And if that stock goes up, that's great. But the only way I can access that capital appreciation of the stock is by selling that stock. So the game stops at one. You can't continue going with the game wise. So that's one portion of that. On the other side of that, what we've seen in the current times, you've also seen dividends slashed with this current pandemic in the stock market wise. So even your REITs, your real estate investment trusts, has slashed the dividends. You look at Laurentian Bank, slashed its dividend wise. You know, unless you're in, I would say one of the top 5 banks wise, your dividends aren't really safe out there wise. And because I look at the dividend yields on the stocks as well. We've seen the dividend yields have gone up on stocks that have gone down in value, but we've also seen dividend distributions slashed as well. So now I'll open up Amit's answer. Yes, yeah, there we go. Basically, Amit did the math right here. So going back in the same again. Yeah, I can invest in the stock, but I can't leverage that investment out of the stock wise. So, and again, I recently bought some dividend stocks this week wise because I do have some stock investments. This is not an anti-stock market conversation. This is just showing you if you have an investment property, how you can grow the your investment property portfolio wise. Audrey Wong, why do you recommend a line of credit instead of refinancing your primary residence? It's all about writing off the interest. It's just key. So that Amit answered that right there. Line of credit, also known as OPM, other people's money. When you save your capital for further purchases, using LOC allows you to have more capital. Also, you only pay interest on the money you use on a line of credit wise, versus when you refinance, you're paying interest instantly. Also, at that time, you're paying, you're doing you're constantly repaying the capital as well. So if you refinance on your principal residence, your monthly cash flow is going to be higher at that time because you do principal and interest payments back. But also the very, very key point, the LOC, so the home equity line of credit, is tax deductible. So the cost is offset. And so if I use the home equity line of credit and I go buy an investment property, I can write off that interest on my home equity line of credit on the income coming in on that investment property. That's the key thing. You can't do that when you refinance your principal residence.
I
James,
think just to add to that as well, in terms of a line of credit, there's a few tidbits. Like most people, the major asset that they own at retirement is their home. And, if you ask 9 out of 10 people, they'll say that they have more equity in their home than they have in RRSPs or cash savings or whatever it may be. So when you take out a line of credit on your home, you can invest that into whatever you like. You can use the money to go on a vacation, you could go to the casino, or you can do what all of us have done, which is take chunks of it and invest it into further properties. And I think this line of credit from Audrey ties into Charles' question, where if you can take $100,000 increments or $150,000 increments and then buy a $500,000 or $600K property, going back to the original comment that your home is the most valuable asset when you retire, why not have 5 of them or 10 of them or 12 of them? Like that is how you get there. And if you can use the bank's money against itself, then that's what other people's money is about.
Yeah, and that again, that's the key wise. You got to look at it over 30 years. You have someone paying off the whole property, so at the end, you're getting this property. So again, versus the dividend stock, and nothing against dividend stocks, bought some this week, but I can't leverage that stock wise. And I'll just go back again. Share my screen, my final slide. Go back here. Go back to my final slide. I can't do this with stocks. I can't build a $33 million portfolio on an initial investment of $39,900 buying dividend stocks. I could maybe build this if I bought Amazon right at the beginning when it launched, or if I bought Apple when it launched. But now you're trying to strike lightning wise, right? You're trying to find that diamond in the rough, and you've leveraged, so you put yourself in a very risky territory, because for every Apple there's a BlackBerry, and BlackBerry still exists. But I remember, in Kyle, do you remember when we had to do because we both took Business 101 at Laurier Wise, and part of our program was they actually give you, here's $100,000 of imaginary money, and they had a whole program built up. Go invest in the stock market, which would have been in 2000, and that's when BlackBerry was actually at its peak value, was in 2000 wise. It was either 2000, 2001, whenever we got the money. I can't what term it was, but anyways, BlackBerry was at its peak value wise, and BlackBerry's never hit that value level again. So if you're like, wow, BlackBerry's on the run, it's the only phone, nothing can beat a BlackBerry, it's the best. I'm taking a mortgage out of $300,000. I'm just buying BlackBerry stock, and we're going to retire. Well, you'd be in trouble today.
We saw people actually do that, Alex, with like Nortel stock. A lot of pension.
Nortel doesn't exist anymore.
Exactly.
Nortel existed then too.
It was the biggest stock on the entire Toronto stock market. I think it accounted for something like a third of the index value at one point. It was crazy.
Mm-hmm. And that, yeah. So again, talking about stocks and dividends wise, again, unless you hit lightning in the bottle, you're not going to get a $33 million portfolio, because you can't do the leverage on the stock market wise. Again, this is not an anti-stock market talk. Is it diversify what you can do if you have one investment property, how you can grow that side of your portfolio using other people's money. You can do tax efficient things with your own money investing in the stock market as well. So again, the first time we've ever really gone in the stock versus real estate trade on one of these chats. But just showing the reference points of that. Okay. We talked about that. Here's the next question. I'm a retiree, and I have a limited Canadian company set up with my brother in Hong Kong. We have been investing we've been in the investment business for the last 20 years in Toronto. Because the law has changed, he being a non-resident, we couldn't get any mortgage. I've tried and didn't get us anywhere. Any advice?
Let me take this one. So I did respond in the Q&A. The answer is yes. You can get a mortgage as a non-resident. So again, being a mortgage broker with access to 35, 40 different lenders, you're not going to get the mortgage at TD, Royal, BMO, Scotia. They're not going to do it. They're not going to understand how to do it. It's not in their risk appetite. It's not part of their risk assessment. There are 3 levels of lending in Canada. There's AAA, which we call A lending, which is all the branches that everybody's familiar with. And then there's credit unions, which people call B lending. And then there's private lending, which is the worst of lending, but that's called C lending. So for non-resident, all we do is go to a credit union. There are probably a dozen in Toronto. The only difference with the credit union is their interest rate is slightly higher. So for example, if the interest rate is 2.5% at a regular bank, their interest rate is 3.5%. Now that 1% differential doesn't cause that much damage to the monthly payment, because it's amortized. So if a mortgage payment was supposed to be $1,000 at RBC, it would be $1,200 at a credit union. So to answer the question, anybody in the world can get a mortgage in Canada. It's about knowing the right team and the right lender to send your application to. So the answer is yes, absolutely, you can get it.
Yeah, it's just about how you structure wise. So I would say definitely reach out to Amit for that one, because there are options out there and he can help you work through that. And we actually addressed a non-resident question like that last week wise, where someone said, oh, I can only have two. That's not the case. You can have more than that. It's just, again, how you structure it wise. I'm a retiree. Oh, no, we answered that one. There was one, the James question. What is the total amount of mortgage? How much you have to pay plus tax and plus maintenance fees? That is more than you are making, so you need to add money from your pocket every month, don't you? No. So James, every property is going to be different wise in regards to, I think what your question is my property going to be cash flow positive with a mortgage and property tax and maintenance fees? The answer is yes. You can find properties that are cash flow positive with mortgage, property tax, and maintenance fees. And that's where we're always looking for our value-based projects to invest in wise. If you are buying in a condo project, let's say, for example, downtown on Yonge Street wise, will that be cash flow positive with your traditional 20% down payment wise? No, it will not. That is not going to exist wise. But there are value-based projects in the GTA, or even we've been promoting investing in Calgary. We're big, very, very, very bullish on the Calgary market wise. I can get you cash flow positive properties today in Calgary with an initial investment of 5% down, closing in 2021 with a lease back from the builder wise, where you will be 100% cash flow positive. So there are options out there wise. It's just working with the people that know how to find you the cash flow options. Your voice was cut off. Could you repeat how line of credit is tax deductible? Okay. Line of credit's tax deductible as long as you're investing in an income making asset, and then you'll write off the interest. Sorry, you write off the income against the interest on the line of credit. That's what it is. But if you go use your line of credit to buy a car, you go use your line of credit to go on vacation, that interest is not tax deductible. Okay, so
from an accounting perspective,
yep.
Just to add that in, the only challenge that comes is if you take a line of credit for 100 grand and you drop it into a condo in downtown Toronto as a pre-construction or a deposit, you can write it off on your tax return. There's a section for that under the interest deduction. However, if you got audited, the auditor's a human being just like you are. They just need to make sure that it is for the reason that you have said it's for. So what I always advise clients is if you're taking money off of a line of credit, it should go directly to what you're using it for. So if you're buying a condo, the line of credit pays directly the deposits. It's not that it goes in your account, you give a little bit of money to your kids, then you give the rest to a condo. An auditor wouldn't be able to track that. So just from a future planning perspective, absolutely you can write it off. Just make sure you have a proper trail of it in the event you ever got audited.
Yeah, very important, Wes. Good advice. Is the strategy to buy pre-construction condos or continue to hold it with tenants to pay the expenses with monthly cash flow? If so, what is your cash flow per door you consider comfortable? Multi-units or single units make more sense. I own it all. I can say all. So I have 14 pre-construction properties that I bought, which are in various stages. 4 of those 14 are complete. The other 10 are under construction currently right now. I own a triplex in High Park, which I also live in. So I rent out 2 units and live in 1 unit with my family. And then I own an apartment building in Hamilton as well. Why pre-construction is so attractive is I'm able to, especially in today's day and age, the rental market is absolutely terrible in Toronto. I won't go too deep into that. The only reason it is due to COVID-19 and borders are closed. So that has having a significant impact on our current rental market. But I know when I buy pre-construction wise, I'm getting it at a future date. And I know that rental rates will be higher at that future date. And the idea is that I'm locking in at a price today and that my future rental rates are going to provide me a cash flow positive situation wise. That's the key of pre-construction wise. And I'm not worried about getting a number of mortgages within a 30, 60, or 90-day period. That's what I would have to do in resale wise. So there's a huge scalability that you can do and planning that you can do with pre-construction that you can't do on the resale side. And I'm going to get the future rental appreciation that's going to cover the costs on these properties wise. When you get into multi-residential, which I own as well, they come with a lot of their own headaches wise, which you move from a passive management to an active management. So again, when we talk about buying condos, they're concrete box in the sky. Typically our clients are busy professionals. They don't even want to talk to their tenants. They just want to know they own a condo. That's going up in value wise. That's the key thing on their end. When you get into multi-residential, there's many more issues that come up with the property wise that are going to they're going to require your time and attention. So in regard to a scalability factor, I think condos are key wise, unless you really want to go into multi-res, and then it's going to become your full-time job managing these properties. And typically, if you're getting into multi-residential, you're getting into secondary markets wise. So my apartment building owner is in Hamilton. You're going to get a different caliber of tenant wise, which is you're going to have more issues with. You're going to end up with the landlord and tenant board. You're not going to, you really don't end up in that situation in condos wise, because you're dealing with AAA tenants. Someone got rid of the next question.
It's sitting and answered. I had just given it a quick response.
Okay, is it better to acquire a mortgage as an individual or to Is it better to acquire a mortgage as an individual or to have a company to take the mortgage, e.g. a partnership? What is the difference, pro, con? It depends on what your structure is. So we've talked about this before. I own my properties in holding companies. I'm a self-employed individual with a corporation. So there's tax advantages for me to have my properties owned in a holding company wise, significant tax advantages for that. If you are a T4 individual, those advantages decrease wise. So it may be better to own them in personal name. It just depends on what you want to do and the scalability and everything like that. But I own mine in holding companies wise. Anything you want to add to that, Amit, wise, in regards to holding company versus personal name?
Yeah, absolutely. So I did put a little bit of a blurb in the question and answer. There's a bit of a misconception in the marketplace about personal holding and corporate holding. From a risk perspective, there's no difference in risk. People always ask me, am I covering my liabilities? Is my risk covered? And I always answer the question with the following couple of examples. If a tenant of yours falls in your condo, it's not you that gets sued. They go to OHIP or they go to their doctor. If the building burns down or something happens to a house, there's home insurance. There's no liability that can actually cause an investor any issue. Taking it to a corporate level, you are always supposed to buy commercial properties in a corporation. So for instance, if you slip and fall at your local Fortinos or Loblaws, you don't sue Fortinos or Loblaws, you sue the company that's holding the building. Now, bringing all that back to residential, it is important to hold in a corporation if you're self-employed, going back to what you said, and especially for professional corporations like people who are doctors and lawyers and accountants and people who own real estate companies, because you can transfer the wealth from one corporation to another in order to buy those properties. So it's a two-part question. Yes, it's good for some people, but don't confuse the risk. Don't confuse the risk associated with a residential holding, because for the average person to incorporate and incur those costs, it doesn't make any sense.
And also in these condos wise, your tenants have third-party liability coverage in those places. So that mitigates the risk wise in regards to lawsuits. So So I'll jump on the next question from Charles. Pre-construction versus already established and built. So great question wise. You can get deals right now, perceived deals, in the resale market today. The only issue is the rent is going to be terrible. So if you were to go into the key, if you're going into the resale market right now, if you wanted to buy a resale condo for investment wise, you are going to want to buy a resale. This is going to be a sweet spot to the market. So everyone write this down. There is a sweet spot in the resale market. It's going to be buildings built after November 15th, 2018. If the property was completed after November 15th, 2018, and you buy resale wise, yes, your rent will be terrible now. You're probably going to be negative. I'm okay with that negative situation because I know the rental rate will go up. So what you're able to do is you're able to get the right discount on the property by buying it today because the market is down. If the building was built after November 15, 2018, there was no rent control on the property. So that means when the market goes back up to normal levels again, which it will when borders open back up, rental market's probably going to be terrible for the next year, 365 days. I expect it to rebound next summer. As long as borders are back up, borders are open back up, you can increase the rent on that property to whatever you want, whatever the market will bear. So that'll be the sweet spot wise. So if you are interested in a resale opportunity wise, that would be the market, the area I would look at. If it was built before November 15th, 2018, I wouldn't consider it wise because you have to rent it out and you're going to be getting a crap rent on it, and then you can be stuck with that crap rent if the tenant decides to stay there long term. And we can help you with those opportunities as well. Kyle is great at that and would help you find those resale investment opportunities.
I actually did look at one for a client recently in that exact situation, and they decided not to just because it's cash flow negative, about $400 a month currently.
Yes. So there we go. So you will be cash flow negative 100% if you buy resale right now, but I do see opportunity in the resale as long as it's built November 2018, but be prepared for it to be cash flow negative. That's all it is. Pre-construction wise, I don't have to worry about cash flow negative today because I don't have the asset. That's the major difference right now. Hector, everything is recorded. Everyone will be emailed a copy of this presentation for those that may have joined late. Alex, all your properties are under a holding company. That is why you get the tax benefits. Okay, so I'll explain where it is and why people that have own incorporated companies own and holding companies. If what I'm able to do is move money from my operating company, which is my business of selling real estate, and I can move that to my holding company. And what the difference is, if I take that money and I take it to my personal name and I invest it, I pay at that after-tax rate on that is my after-tax personal rate, which is higher than my after-tax business rate. Significant difference, 54 versus 12.6, I think, or something along those lines. So I'm investing at 12.6%, 54% tax benefit for it.
If I could add to that. So when someone has a corporation, let's say, they have $500,000 sitting in their corporate bank account, there's two ways to invest that money. Either they pay themselves, let's call the individual John Smith. So they pay John Smith, but then John Smith has to include that in his personal income, and the tax is based on your personal taxes. Let's call it 46%. But if the money of $500,000 sitting in the corporation, and the corporation then sends it to a holding company, which is buying real estate, there's no tax impact because it's just a loan from corporate to corporate. So that's the short answer of why it makes sense for people in business.
And for those T4 people like, oh, why are these people getting the tax advantage wise? I just want to also say there is no pension for me. There is no Canadian. I don't pay into the Canadian pension plan. There's nothing. If I were to retire tomorrow, I have to rely on everything that I've created on myself. So all this investing in real estate, what I'm doing I'm building that, what you're seeing on the slide wise, I'm building my pension plan for the future wise. So I'm building my own pension plan through real estate. That's what I'm doing. And even if you're a T4 individual, and we were talking about stocks earlier, but this also applies to pension plans. Those people that are sitting there going, oh, I have a pension, it's safe. Well, let's talk about Sears. Let's talk about Nortel. You know, these were major corporations that had pension plans that don't exist anymore. So if you're with a corporation with a defined benefit pension plan, which are rare these days, defined benefit pension plans, that may not exist in the future if your company does not exist in the future wise. So you need to start building your own pension plan, and I build my pension plan through real estate wise. That's ultimately what I'm doing, what Kyle's doing, what Amit's doing. You know, we're building our own financial security for the future wise. We're building our children's financial security and the future wise. That's what we're building. Charles, great question. What makes November 15, 2018 so special? That is when the conservative government removed rent controls. So it was the conservative government that removed rent controls for units completed after November 15th, 2018. So it's government policy. And Nadia, how would you rate pre-construction townhouse versus condo? Of the 14 pre-construction properties I have, I own one pre-construction townhouse. It was actually the last pre-construction property that I bought. I bought it in Union Village in Markham, and a Minto development wise. That one there I bought as more of a speculation buy because I saw the demand for the property wise. The one thing about townhomes is most likely I'm going to attract a family, and that could have more wear and tear on the property as well. It is a freehold property, so no, I don't have any maintenance fees, which is great, but no, I don't have any maintenance fees. So that means I have no one else is looking after the property wise. So all that wear and tear on the property and upkeep and everything like that, that's my responsibility. That exterior of the property is my responsibility, not someone else's. So again, there could be some more management involved with the townhouse wise. So just your prerogative on how much work you want to be dealing with a property. Charles, how long do you have to wait before you should take equity out of your property to reinvest? Great question. You could do it the next day. So Amit, I'll let you jump in on that. Oh, I've personally done this with Amit wise in regards to nearly instantaneous. I shouldn't say nearly instantaneous. It's about 2 weeks before you actually get a check. But why don't you talk about that a little more?
Absolutely. So again, it goes down to the minute differences between the banks. You know, a BMW is a Mercedes, is an Audi, or a Honda is a Toyota. Same thing happens when you're dealing with Scotia or TD or Royal Bank. Some banks don't. Some banks' policy is you have to wait approximately 6 months or 12 months before you can refinance a property. But there's actually a lot of banks out there, including some of the big ones, that they will let you refinance the property immediately. So for example, you buy a condo for $500,000, you've put 100,000 in years ago. At the day of closing, the condo's worth 700,000. So on the closing day, you take your 400,000 mortgage and you close the deal on, let's call it August 1st. Literally on August 2nd, we can send the application in to get you the refinanced amount based on the appraisal. So again, it comes down to simply the minute details with the bank, but the answer is you can refinance the next day.
Yeah, and and that's again working with Amit wise. You're going to learn these different strategies on where, when, and how, and where you can take money. So I'll give you another strategy wise. You know, there are instances where I just closed all cash on a property. So what I mean by that is, let's say I bought it. Well, no, I did buy it. I bought condos for a very low price in 2013, 2014. The mortgage was coming, so the property was completed. So my outstanding amount that I owed the builder was $200,000. So what I did is I just gave the builder $200,000 off the line of credit off my house wise, and then 2 weeks later I just got to put a first mortgage on the property at current market value. So there's different ways to do that to take money out and access the equity quickly. Again, different strategies that Amit can discuss with you depending on your situations wise. Are there any outstanding questions sitting in the chat wise that we should look at, or did we get all those? I think, oh yeah,
All got them all.
yeah, we got all those. Okay, so guys, we made great time here today. Amit, do you want to share it? There'll be an email to everyone, but Amit, do you want to share all your info in the chat wise?
Absolutely.
So thank you everyone for taking the time today. Kyle, thank you for moderating and giving your input. Amit, again, thank you for providing your expertise. This whole thing has been recorded. You will all get an email on this recording. My information, Kyle's information, Amit's information will be in the email that goes out. So if you have any questions, you can reach out to us, book a call with us. We'd be very much happy to help you with your journey and helping you build financial freedom and generational wealth. Everything that I showed you today, everyone on this call can do. You can all do it. It just requires you to reach out, and we'll show you how to do it. So we hope to speak with you all soon. Okay. Thanks so much.
Absolute pleasure. Thank you, everyone.
Kyle. We'll talk to everyone later.
Bye, everyone.
Bye.